Hello, everyone, and welcome back to the Association of Corporate Treasurers and our Treasury Forum. I'm James Winterton, an Associate Director for Policy and Technical at the ACT, and it's really my great pleasure today to introduce our keynote speaker, Chris Faint from the Bank of England, where he is Head of Climate and Small Mutuals. Hello, Chris.
Hi, James, and good morning, everyone.
Hi. So yesterday, of course, one of President Biden's first actions was to sign an executive order bringing the USA back into the Paris Climate Accord. So it's particularly timely to have Chris with us today. In June 2019, the UK became the first major economy in the world to pass laws requiring it to bring its greenhouse gas emissions to net zero by 2050. And over the next 45 minutes, Chris will discuss the journey towards net zero, building a resilient UK financial system. He will focus on climate, his particular area of responsibility, but I hope we can tease out a few observations on the overall economy too. To make the session more interactive, Chris has kindly agreed to a Q&A format for this talk, and you'll see me glancing down to check my screen for any questions from you, the audience. So to submit your questions, you'll find the Q&A box on the toolbar at the right-hand side of your screen, and we'll try to group questions by theme and to tackle them as we go along. So please don't wait until the end, and we will keep them anonymous. The session's being recorded and will be made available for replay by the end of the day. And finally, on housekeeping, you can engage with the ACT on social media by joining the ACT's active LinkedIn groups, following us on Twitter at ACT Update, and by tweeting using the hashtag ACT Treasury Forum 21. So turning now to Chris. Chris, I think before we get into the formal Q&A discussion, while we're awaiting questions, first, can I ask you at a personal level, what does it mean to be head of climate on a day-to-day basis, and what motivated you to take up this role?
Well, morning, everyone, again, and thank you so much for having me here today. Look, I think that's a great question. It's very rare in central banking world that a topic comes up that is very, very new, is something that people feel really passionate about, including myself, and is the kind of area that you can shape. So about 3 years ago, when I took up the role looking after the development of the climate strategy for the Bank of England, it actually only had 2 people working on it in the whole of the bank. I don't know what the number is now because it represents such a big part of what the bank does and is distributed across so many people in the institution, but it is a lot more than 2. And what's really motivated me is to be able to take something that's been relatively embryonic in terms of an agenda, both domestically and internationally, and then be able to help shape that. And I would like to think that the Bank of England has been a key player in the narrative around climate change across central banks over that period. And one of the things that I can bring out today is what we've done, where we've got to over this period, and also what we're going to be doing in the future, again, domestically and internationally. Yeah, so a lot of progress to date, but a lot still to do.
Chris, that's great. You talked about the future, but for the first question, in the short term, firms, whether banks or corporates, are tackling the COVID crisis and arguably the worst economic conditions in living memory. They also have to contend with Brexit and LIBOR transition. So the first question is, in the current economic situation, do firms have the capacity right now to be thinking about climate risks that we hope will not crystallize for decades?
And I think that is the key question of the moment. I mean, it really hit home to me the other day, just how people feel about this, when a presentation that I was doing on climate change was described as some light relief, given everything else that was going on. But I mean, just to give some stats around where we are at the moment from an economic perspective. I mean, global growth is expected to be 4.5% lower than it would have been. The cost in output over 5 years from COVID is expected to be almost $30 trillion. And global public debt is expected to get to 100% of GDP this year. But of course, it's not just about the finance. It's having a very real impact on people, from the human impact of what we see in our societies to extreme global poverty being up by 1.5% compared to where it would have been otherwise. So I don't need to explain why COVID is such a major issue at this time. And you're right. I mean, there's a lot going on at the moment in terms of Brexit, in terms of some of the issues that are more under the radar, but are actually huge issues for those people listening today, such as the LIBOR transition. And it is taking up a huge amount of bandwidth within institutions, both within the finance industry and the real economy. So I'm very sympathetic to whether there is the bandwidth to talk about climate at the moment. But let me explain why I think it is important that bandwidth is maintained to look at climate. So climate is a slightly unusual issue. The ex-governor of the Bank of England, Mark Carney, described the tragedy of the horizons, and this is the issue whereby at the point at which you realise how severe the risks are from climate change, it's too late to address them, and really what we need to be doing is addressing those risks as they develop now, and to provide some numbers around that. As you mentioned, it's a momentous day today because the US has rejoined the Paris Climate Accord. And in that accord, there was an agreement to limit global temperature increases to 2 degrees above pre-industrial levels, or ideally 1.5 degrees. Now, at the moment, we're around 1.1 degrees, and the temperatures are moving very quickly. And some analysis suggests that if we don't do anything, temperatures could be 4 degrees above their pre-industrial levels. And we've not seen temperatures above 3 degrees for 3 million years on this planet. So we'd be going into a world that is quite unprecedented. Now, in order to get to 1.5 degrees, governments will need to get to net zero emissions by 2050, and as you said, the UK has committed to do that, but it's not this kind of thing that you can just turn on a switch in 10-20 years time and then decide to get to net zero by 2050. You need to start doing it now, and there's 2 reasons why you need to do that. The first one is just one of practicalities. There's such a mountain to climb. You need to do it gradually. You need to move the economy in a way that allows the huge mountain to be chipped away at over the next 30 years. But also there's a point of risk. If you move too quickly, you create transition risks, and you give rise to stranded assets, stranded companies, and that is a major risk in itself. So that transition needs to be managed. And this is where central banks and governments come in to try and help smooth that process. And I'm sure that many of the listeners today will have started to think about what transition means for them, particularly in the UK with the transition to net zero. So to go back to my previous point, whilst it is essential that the major issues of the day are dealt with, particularly COVID, and we have to deal with things such as Brexit, and we also need to deal with emerging issues such as LIBOR transition. If we don't deal with climate risks today, it will just be storing up risks for the future. So the prudent thing to do is to try and find time to deal with them, to build them into business processes as soon as possible, to understand the risks and the opportunities of addressing climate change. And just one very quick point on this. Actually, we were really worried when COVID started to become a major issue around a year ago, because we thought it would suck all of the air out of the room, and we were worried that it would mean that the climate transition would be pushed back. Actually, we've not seen that. Whilst firms do have less time to spend on climate, and governments and other agencies also have less time to spend on it, actually the agenda has been pushing forward quite quickly, because there is a recognition that it's important and not an issue that you can leave to another day. So I think the signals are positive, but we just need to continue getting that traction in each of our jobs.
Well, Chris, you bring out some fascinating parallels there with COVID and the need for sort of prevention being better than cure. So there's a compelling case for change. But what is the role specifically for the Bank of England here? Or you could even widen it to central banks more generally. Why is the Bank of England active on climate? Isn't that the role of politicians?
Yeah, so it's definitely a responsibility for politicians, but the central banks do have a role here. So if you look at the Bank of England's mandate, it's got a mandate for monetary policy. It's got a mandate for the safety and soundness of the firms that it regulates, which is largely banks and insurers, and also it's got a financial stability mandate. If I focus on the last two, just to bring out why we think climate's important to those. From a safety and soundness perspective, banks and insurers sit right at the centre of the economy. And therefore, any risks that arise in the economy will eventually arise within those institutions. So our observation has been that when those institutions are thinking about the business that they do, they should also be thinking about the climate risks associated with those. And this is born out of an observation that climate risks are not currently appropriately priced into markets or into the operations of institutions such as banks and insurers. So what we have been saying, and we issued supervisory expectations to all of the firms that we supervise last year, saying that by the end of this year, they need to have embedded an understanding of climate risk into what they do. Now, I can go into that in more detail later, but essentially what that means is firms, banks and insurers should be pricing in the risks from climate change. And those are two types of risks, the transition risks that I talked about, but also the physical risks of the world changing around us. And they should be thinking not just a year or two ahead, but they should be thinking decades ahead in terms of the damage that it could do to the assets on their balance sheet and their go-forward business models. I'll touch on why that is a challenge slightly later in this session. But the other point that the Bank of England is particularly interested in is from the financial stability perspective. So as we look decades into the future for the UK, and as we look at the transition to net zero by 2050, we observe that the transition that I talked about has to be undertaken. Now, if it's smooth, then we want to understand what that transition looks like. We want to understand where the opportunities and risks are, particularly from financial stability perspective. But also we recognise that it might be that it is not smooth, and it might be that there is a jolty transition, which gives rise to some unexpected kind of cliff edge risks in the future. And that is what we're working with industry to understand. And by I say industry, it's not just industry, it's across the economy and the financial firms to understand what that means, because it is risks that is economy wide. And our observation is that no individual firm will be able to escape these risks, because you can't just offload climate risks later in the future, where at a point potentially where all of your peers will be offloading risks. So you need to understand them now. And to help understand what these risks look like, the Bank of England will be doing stress tests, scenario analysis on different climate pathways to understand what that means for the real economy, for financial firms, and I'm sure for many of the listeners today.
Chris, you talked about expectations for banks and insurers. So in other words, the regulated financial entities that fall under the Bank of England's supervisory oversight. Could you just elaborate a bit more? What is the bank actually doing to address climate risks? And particularly, you touched on product pricing, credit ratings. So what does all this mean for those listeners on today's call whose businesses are not financial in nature?
So the the expectations that we have, as I said, are for firms to embed risk and to price in climate risks. Now, that is much harder than it sounds, because in other risk disciplines, you can look at what's happened in the past, and you can get data, and you can develop models, and you can understand to an extent how risks might evolve in the future. Our belief is that climate risks are relatively unprecedented. On the physical side, the changes in the global weather systems will have similar features of what we've seen before, but frequency and where they happen will be different. So they are very hard to model, and transition risk is incredibly hard to model, because how do we know what IT will be developed or what government policies will happen and how government policies will vary across the globe? So transition risks are a real challenge, an unprecedented challenge. So what we've said to firms is that we recognize these challenges, but the fact that it is challenging is no excuse to do nothing. You need to form a view on what that risk looks like, and you need to use judgment, and you need to speak to your counterparties to understand what those risks will look like. So our expectations there's 4 categories. The first one is governance. We've said that across the institutions, they need to talk about climate risks from a board level down. We've said risk management. They need to embed climate risks into their engagements with their counterparties and with their pricing of products going forward and their understanding of risk. So for all of those on this call, what you might expect in the future is that your bank or banks will be having discussions with you to understand better what is your business, what thinking have you done about climate risks and how that could give rise to future risks in your business. And banks will also be looking at credit rating agencies, and credit rating agencies will also be thinking about climate risks. So as the science around climate evolves, credit rating agencies will be thinking, well, what does this mean for the viability of firms in the future? And that will be increasingly priced in. And you've seen some moves from credit rating agencies in this direction already. And I should say it's been noticeable that credit rating agencies have brought up a lot of the smaller climate scientific consultancies over the last years as they've been seeking to develop capabilities in this area. Then we've said to banks and insurers that they need to run scenario analysis, because it's not just a matter of understanding what risks look like today. They need to understand what risks look like in the future. And in order to do that, they will be having discussions with their largest counterparties to begin with, but I suspect over time they'll be building these discussions into a broader set of counterparties. And the sort of questions they'll be asking are, how vulnerable is your business to different climate pathways? What thinking have you done around different climate risks? And they'll be building that into their process. And then we'll be asking them to run scenario analysis, putting all of that information together. And that will allow us to form a view on how risks will evolve in their businesses. And then we've asked them to disclose on the back of this. Across the climate agenda, disclosure is something that comes up a lot. And I can dig into this in more detail later if useful. But what we've said is it's not enough to just internally have a view on this. There's an appetite in the markets to know what you're doing in this space and what you think the risks look like. So you should be disclosing what that looks like in line with all your other risks. This is all incredibly difficult for firms to do. We've given them till the end of 2021 to embed this in their operations. And we are sympathetic to how much of a challenge this will be. But for the reasons I said before, we think it's important that we get traction on this very quickly. And that is why we set the deadline that we've set.
Chris, I'd like to come back in a minute on the point about disclosure. But first, just picking up on the scenarios that you mentioned. Can you just add a little bit more color? I realize you're not allowed to actually give an economic forecast, but can you give a bit more color about how do those scenarios envisage what happens to the business economy over the next, let's say, the next decade, to give context to our corporate treasurers who are trying to do their risk analysis?
Yeah, very happy to. Um, within the bank, we've been looking at this in a lot of detail because we've committed to undertake a climate stress test that will launch this year. Now, let me just set out first why this is different to other stress tests or scenario analysis, because there are some key differences that make this really tricky. In a normal forecast or stressed forecast, the kind of variables that people will be using in the real economy and also in the financial economy are the classic macro things, such as unemployment, house prices index, GDP, the usual toolkit. But with climate scenarios, instead of forecasting over 3 to 5 years, actually you're forecasting over many decades, because that's the period at which these risks grow. And instead of just having those normal macro scenarios, you have variables that seek to capture the impacts of policy change, technology change, and the key one for that is carbon pricing. So in climate scenarios, what you'll typically see is fluctuations in global carbon prices, and those are used as a tool to be able to understand how expensive carbon-intensive operations become over different periods. Now, in terms of what the scenarios look like, I mean, there are over decades. There's an infinite amount of different scenarios that you can have. So what we have done, and this is publicly available through an organisation called the Network for Greening the Financial System, which is a group of international central banks that have come together. We've recognised that there's a gap in the market for some reference scenarios that people can take and in a consistent way undertake climate analysis. So the Bank of England has been leading a work stream within this group, working with leading climate scientists to develop these reference scenarios that can be extracted for free and used to undertake analysis. Now, there's 3 main scenarios that make up this toolkit, and what they seek to do is provide the parameters of what you might expect to see. On one side, there's a scenario that we call an orderly scenario, and what that encompasses is policy action being rolled out in a measured way over the next 3 decades to transition the economy in a safe way. And what that does is it reduces the transition risks that I was talking about before. And also, because it reduces carbon in the atmosphere, it reduces physical risks because there's less global warming. At the other end of the extreme, we've got a scenario that says, well, what if there is no transition? What if we do nothing? And under that scenario, by the end of the century, you get to global temperature increases 3, 4, 5 degrees, depending on how you want to calibrate it. And in that scenario, you don't have any transition risks because there's no transition, but you have increasingly severe physical risks that impact the economies, impact everyone in the economy. And there's a geographic spread of those impacts because you'll have increased flooding in some areas, increased hurricanes in other areas, and of course, just general global increases in temperature that can give rise to things like migration of people, which would become a very major risk. And then you've got something in between. The third scenario is a late transition scenario. And what that says is, for whatever reason, we don't undertake a transition in any meaningful way for, say, 10 years. And then we suddenly realize it's really important that we do undertake a transition. So you have an abrupt transition in the economy. It means that you reduce the physical risks because you very, very quickly change the nature of the economy, maybe by increasing carbon prices very abruptly. And but it gives rise to a lot of stranded assets, the need for adaptation in a very, very short period of time. so each of those three scenarios provides a different cross section of risks that we think are useful for all members of the society, members of the economy to look at. And when we do our stress test, those are the scenarios that we will be using, because we think from a financial stability perspective and from understanding the safety and soundness of the banking and insurance industry, these are the kind of things that we're going to want to understand to parameterize our thinking. When we do run that exercise, and the results will be coming out next year, it will give us a really good insight into where the pressure points in the economy are. So what if we, for example, see that in certain industries, insurance provision falls back quite a lot? For example, in the UK, if insurance providers don't think that they're able to viably provide mortgage insurance in certain areas, then that is important for us to know. But similarly, if some sectors of the economy become unviable for banks to deal with at some points in these 3-decade scenarios, that's also useful for us to know. And furthermore, we're looking at how banks are going to be dealing with those sectors. So if all the banks come to us and say, look, we'll provide provisions until this point in time, and then they all say that they're going to exit that provision, we'll be pointing out that they can't all exit at the same time, because that creates a stability issue, but also they shouldn't assume that there's enough business elsewhere for all of them to suddenly exit. So it will help the dialogue that we have with institutions to understand what a smooth transition will look like.
Chris, I'd like to just stick with the climate stress tests for a minute, because indeed there's been a huge amount of noise about this, particularly for financial firms in the UK and abroad. So you touched on the implications for corporate customers of financial firms, and in the retail market, you mentioned mortgage insurance implications, for example. Earlier in the conversation, you talked about stranded assets. So I think it'd be really helpful if you can just elaborate on perhaps the secondary implications of these climate stress tests on the regulated sector. What are the implications for the corporate non-financial sector, and what conversations do you envisage corporate treasurers should be having with credit rating agencies going forward?
Yeah, so the climate stress test has two purposes. The first one is to help us as the bank understand financial stability concerns, and that would inform future discussions around the bank's role in terms of mitigating those risks. From the safety and soundness perspective, we will be looking, as I said, at how exposures for banks and insurers develop. Now, there is a correlation here, I think, between pricing and between provision of services and riskiness in sectors over the 3 decades. For a sector that is not risky at all, you might expect pricing to reflect that lack of riskiness, and you might expect there to be more demand from banks to service that sector. For those sectors that are very risky, you might expect that banks would be pricing in that risk at an early point, or they might be deciding that their preference would be to not deal with certain sectors given that risk. Now, I should stress that we don't see this as being an immediate thing. It's not that the results come out next year and suddenly the whole banking system shifts. That is the opposite of what we would want. What we want is to just make sure that there's a focus on how risks will arise, and that impacts the way that institutions operate. But look, I'm a central banker, so I'm naturally focused on risk, but it isn't just about risk, it's about opportunities. So as we move towards a new economy, there are going to be huge changes and opportunities are huge that come along with that. So there's some estimates that suggest that in order to facilitate a smooth transition, you would need $3.5 trillion of additional investment every year. So one of the things we're also asking is, how are you seeking to tap into those opportunities? Where are those opportunities going to come? And what kind of discussions are you having at the moment with your counterparties to understand those? So for those on this call, I would expect that over time you're going to be hearing more of these questions from your banks and your insurance companies. But I would suggest that the kind of analysis that we're asking those firms to do is the kind of analysis that would be useful for any firm. Stepping back, thinking, what are the risks? What does my firm look like in the transition? How can I be acting now to mitigate those risks and seize opportunities? I think is a very good discipline for all institutions, and we're starting to see it a lot more across the real economy. So it's quite pronounced in those sectors that you might think are totemic from a transition risk perspective. I would bring out the example of BP, almost the poster child of who you might expect to be impacted by future changes in carbon prices. And what they've done is they've undertaken scenario analysis, they've published their scenario analysis, and they've said, in light of what we're seeing, this is how we would expect it to impact our strategy going forward. So I would encourage all firms to be thinking through what future risks and opportunities look like. And I also think credit rating agencies will be increasingly asking about this and running their own analysis of where risks might lie. And as I mentioned before, they've taken their time to make sure that they've got the data and analysis that they need to undertake analysis. But they are very well equipped to do it now, and they're already having discussions with firms to understand what they're doing. The last thing that I would say on this is about market appetite to understand this beyond credit rating agencies and beyond us as a central bank. There is, especially over the last year, there is a huge uptick in calls for firms to be transparent about the thinking that they've done on climate risks. And there is a huge push for markets to reflect climate considerations better. The main manifestation of that is in disclosure, and TCFD disclosures, so the Task Force for Climate Financial Disclosures, is the main medium that disclosure has followed to date. There's international push for that within the UK. They've made it mandatory for a whole swathe of the market, and as part of TCFD, one of the requirements is that firms are undertaking scenario analysis to understand their climate disclosures. So my view is that all of this comes together in the disclosure place. The disclosures of where scenario analysis leads to risk, leads to openness about how firms are thinking. And I think the pressure will increase over the coming years for firms who aren't disclosing where they are in terms of their climate thinking to disclose where they are on that.
Chris, you mentioned disclosure a couple of times, and indeed earlier in the call. So I think there's sort of two aspects to this. The first is we hear from corporate treasurers that they're facing a multiplicity of different reporting requirements, particularly internationally. So the first sort of strand of questioning is about, will we see international alignment of reporting standards on climate-related risks? But then specifically for the UK, how does the disclosure you're talking about link to UK authorities' recent moves towards making climate disclosures mandatory? And I think particularly here, what's being reflected is the FCA requirement for companies with a UK premium listing to include a statement in their annual report for periods beginning on or after 1st of January 2021, setting out whether they've made disclosures consistent with the Task Force for Climate-Related Disclosures recommendations that you referred to. So, Chris, two aspects there, one of which is the international alignment, and the second is how does the UK disclosure regime, how is that extended to non-financial, non-regulated entities, please?
Yeah, so I think it's fair to say that the UK's probably gone further than almost any other jurisdiction in terms of what it's done on disclosure. I think the only other country that maybe has gone further is France. They've had climate disclosures built into their requirements for some years now. So what's happened is that the UK government convened a task force of regulators and relevant parties to look at whether and how the UK should move to mandatory climate disclosures. At the end of last year, the Treasury, who was in the lead on this, announced that firms over the next 5 years, but weighted towards the beginning of that 5 years, there will be steps undertaken by those members of this task force to make disclosures mandatory across a large swathe of the economy. So the first one, as you've mentioned, to come into force will be the FCA's requirements at the end of this year for premium listed firms. And then the year after that, a wider pool of firms will be caught by the FCA, and that's across the economy. That's not just any specific sector. DWP have made rules for pension firms, and the Bank of England actually hasn't made new rules, because we already had rules that said as supervised firms, banks and insurers need to disclose their risks, and our expectations are that they will be disclosing their risks by the end of this year as well. So we're seeing a very, very quick uptick in requirements for disclosure across the economy, and this is relevant because firms don't just have the information they need to disclose; they need to develop that information over time. And that means that they need to look at their risks from a different perspective. So the Bank of England did its own disclosure, its own TCFD disclosure, and it's incredible. It required a whole load of expertise that we did not have in-house, so we had to get experts in to help us with that. And I think premium listed firms will be doing exactly the same this year. So how do we gather the information that we need, and how do we get to a point where we can do a good disclosure? And in a lot of cases, again, particularly for banks and insurers, that means that they're going to need to speak to their key customers. In their case, it's their key counterparties, to understand what their exposures look like, because there's a link between the two. So in the UK, I think we're going to see a huge movement in terms of the amount of climate information that we have over the coming 5 years, but particularly over the next 2 years. And my belief is that for those firms that don't publish where they are, for whatever reason, I think there will be a question about why they're not publishing. Is it because they don't want to publish where they have got to, because there's something that they don't want people to see, or is it that they don't have a good understanding of this? And there'll be a push from investors to unpick that a little bit. The one point that I haven't talked about at all today, but it's really, really important actually, is one of proportionality. I think all of this is incredibly scary for smaller firms that don't have the same kind of resources as larger firms. And there is a huge mountain to climb in terms of understanding risk and disclosure. From a Bank of England perspective, whilst we are asking firms of all sizes to understand their risk profiles, we are very, very clear that that should be proportionate to the size of firms. From a disclosure perspective, disclosure requirements do not bite on all sizes of firms. It will be proportionate to the size of firms. And I would, whilst I would advocate understanding the opportunities and risks for firms across the economy and ideally disclosing across them, I would encourage all firms to think about what's proportionate for their resources and what they are able to do in the time available, because this isn't the kind of thing that everyone can just reach best practice immediately. It will take some time.
Chris, that's fantastic. Thank you. So we're sadly we're already beginning to run short on time, and there's countless more questions we could be asking. But I do particularly want to ask you about COP26, because this is going to be a huge year for the UK as it hosts the G7 summit in June, and then COP26, the 26th conference of the parties to the UN Convention on Climate Change in November. So the question is, what should we expect to see from COP26, and what is the relevance of COP26 for corporate treasurers?
Yeah, so COP26 is a great opportunity for the UK, particularly in a year where we're hosting the G7. Conscious of time, I'll be very quick on this, but what COP26 is seeking to do is seeking to say we need to finance the transition to a net zero economy. It says in order to finance the transition, we need to make sure that the market understands what finance is required and the market mechanisms are in place to allow us to channel funding in a transparent way to the areas that are needed to reach that net zero point. So what you can expect to see from COP26 over this year is a movement for more transparency to allow us to understand where the needs are, a movement to try and unlock financing, try and push things such as green bonds, a movement to try and create transparency in markets by creating new metrics that are understood, things such as a portfolio warming metric that allows you in a consistent way to understand what climate trajectories different portfolios might mean. And by the end of it, what they would hope to see is a much more vibrant green bond market, more transparency about what a green bond actually is. At the moment, when you lift up the bonnet, it can be a lot of different things. And as a result, a much smoother transition. So I think that will be front and center for treasurers over the coming period, given their numerous roles.
So, Chris, before I bring the call to or discussion to a close, can I just ask, maybe just in 30 seconds, do you have any final words of advice for the business CFOs and corporate treasurers who are listening to today's call?
Yeah, I think my key point would be that whilst there's a lot happening in the regulated space in terms of understanding climate risk, you shouldn't see it as totally distant from your own businesses in two ways. I mean, the first one, there is just a link between what we're doing in the regulated space and the broader economy, but also the tools that are being developed into things such as scenario analysis, risk understanding, are tools that we would hope you'd just be able to pick up and use in your own institutions to understand the risks and the opportunities. And whilst there might be a temptation to leave that process to a later point, we would encourage firms across the economy to start doing that now, because the transition is happening now, risks are crystallizing now, opportunities are available now, and the sooner that they're understood, the sooner that they can be addressed.
Well, Chris, it's been absolutely fantastic having you share your views so freely with us today. So thank you so much. And everyone, we've heard some great insights from Chris, and some of the themes that Chris has highlighted will actually be explored in the next session of the Treasury Forum, a panel discussion on redefining sustainable finance in the face of COVID-19. And I'd like to thank those of you who contributed questions. Obviously, we've covered as much ground as possible. I apologize if we didn't get to your particular question, but it would be really helpful if you could please fill in the quick survey, feedback survey immediately after this session. Your feedback is really helpful designing future events, and you'll find the feedback button located by the Q&A box. You can watch this session and indeed other of today's sessions again for 14 days after the event on this platform. And I'd just like to add, we're very grateful to HSBC for sponsoring today's Treasury Forum. And HSBC and the ACT invite you to pay a visit to our virtual exhibition hall. Make the most of your networking opportunities there by chatting directly with fellow delegates within the networking lobby. But finally, on behalf of the audience, I'd like to thank Chris Baines and the Bank of England for speaking so openly with us today. This has been James Winterton for the ACT. Thank you and goodbye.